Let's talk about some of the markets and strategies that I think traders should be keeping an eye on as we go into the last part of 2021. My name is Carly Garner. I am a futures and options broker. I run a futures and options brokerage in Las Vegas, Nevada. We're a boutique shop. We're not the biggest. I'm biased, but I think we're one of the best out there. If you have any questions, comments, concerns, you can reach me at this contact information. If you're on social media, check us out. I've written several books, but the three that you need to worry about are right here. You will find, if you go to Amazon, you're going to find a bunch of other titles. Those are from previous publishers. Don't worry about those. All the information has been improved upon and expanded upon and put into these three books. So if you're interested in learning more, you can also visit our website, tradingcommodityoptions.com or decarlytrading.com, which was on the previous slide. Before we get started, just want to remind everybody we are talking about trading futures and options on futures. There's substantial risk involved. There's definitely no easy money. In fact, most people lose trading commodities, and there's lots of reasons for that. Most of it is because the commodity markets offer free and plentiful leverage, and it's hard to manage for some people. And to be quite honest, the bigger your trading account is, the more likely you are to survive some of the ebbs and flows. It's really difficult for a very small account to manage the volatility. And the nice thing is the CME recently issued micro contracts, which are very small futures contracts, and there are some options in the stock indices on the micros that allow smaller traders to utilize strategies that make a little more sense. Today we're going to talk about some of the full-size contracts, so keep that in mind as we're going through. In some ways, they're risk-averse strategies, but in other ways, they are actually very risky strategies because they involve option spreads with naked leg. First, let's take a look at gold. Gold has had a really rough go at it thus far in 2021. We did see a decent sized rally in late spring, but it's given all of that back. I happen to think this is probably a buying opportunity in the metals, but only time will tell. Gold is in a long-term uptrend. That does not mean that being a bull is comfortable. It's never comfortable, especially in the metals. The metals are the kind of market that you have to be in it to win it. Once the train leaves the station and you're not in, it's really hard to chase prices higher. And in fact, it's a bad idea to chase prices higher because it ends up generally being a very dangerous proposition. Even though the metals have the propensity to move higher really quickly, they can also see very treacherous corrections, even in bull markets. And this makes it a tough market to trade with futures. We're going to focus on the full-size contract, more specifically options. This is a chart of gold. It's a weekly chart. Gold normally does very well in August. I know we've gotten off to a rough start this month. You can see the last two weekly bars on this chart are pretty ugly. But in all honesty, the market might have actually needed that flush out to retest the lows from earlier this year and basically wipe out some of the weak hands, the stop loss orders, all that kind of stuff. When markets flush out like this, a lot of times they just turn around and go back up. And the reason being, everybody that was stopped out and flushed out, they now become very motivated buyers. The FOMO trade flips the other way pretty quickly. We saw that in March, April of this year. You can see gold bottomed out. It actually put in some sort of a double bottom and started running to 1900 very quickly. And that's because everybody that was forced out of the market was scrambling to get back in. And I think we might get something very similar to that. If not, the next level of support is going to be trendline support, and that's about 1620. So you want to be careful getting too aggressive if you don't have the money or wherewithal or mental capacity to ride out a move to 1625. I know that sounds like a long way away and it seems impossible, but trust me, in gold, nothing is impossible. The nice thing about the recent volatility that we've seen in gold is it sets up a lot of option trading opportunities from now through much later in the year. This is an example that I came up with based on today's pricing using the December options. Obviously, prices change quickly, market conditions change quickly. So this is not a recommendation. It's just an idea for you to hopefully get some of your creative juices flowing so that if you do decide to participate in a market like gold, you have some ideas on how to play it without doing the traditional game of buying futures and placing stops and getting stopped out and so on and so forth. So this is just a different approach. For some people, it might be a better approach. For some people, it might be worse. The great thing about trading is there's no right or wrong way. The right way is how you're most comfortable. And I know that sounds weird, but the reality is trading's a mental game. So if you're more comfortable, you're going to make better decisions. It's that simple. This is a strategy that I think might make a lot of sense here because the market has dropped so sharply in the short run that the call options have become very cheap and the put options have become very expensive. So if you put together an option spread that involves the purchase of a call option, which is cheap, and then the sale of a put option, which is expensive, and then also a sale of another call option just to help finance the trade, even though that call option is on the cheaper side. You might be able to together something like this. So these are the December options. They expire in about 100 days at the time of this video. For roughly $800, $840 in cash, you could have purchased this spread buying the December Gold 1750 call, selling an 1850 call, then selling a 1625 put to pay for it. The idea is options are very expensive. You can see the December Gold 1750 call. To buy that outright, you'd have to pay about $46 to $47 for it. That's $4,700. That's a lot of money for an option that's probably going to, well, I don't think it's going to expire worthless, but most options do expire worthless. So if you're spending premium, you have to understand you're buying an asset that erodes and may or may not work out. So it's always a good idea, in my opinion, to help pay for that option. And you can do that by selling the 1850 call and the 1625 put around it. So instead of paying $4,700 for this option, we're only paying about $800 for it. So we're getting into the market cheap. The downside of this is we're selling a 1625 put. You can see it on the chart here. That's where you have risk. So it's not all sugar and spices. If you're doing a spread like this, you're getting to the market cheap, and that's great, but you're giving something up. And what you're giving up is unlimited risk below the strike price of your short put. So if the market collapses below 1625, it's basically like being along a futures contract from 1625, and you have theoretically unlimited risk below. I believe, unless something really weird happens, you should be okay with this trade. We're putting that 1625 put at trendline support, and it also is quite a ways away from the market. It's about $100 under the market. So if something does go wrong, hopefully you have enough time to react before things get out of control. Believe it or not, even though you're paying $800 to get into this spread and you're accepting unlimited risk under 1625, the profit potential is pretty nice. If you hold all the way to expiration, and that's a really big if, most traders don't do that. Just to give you an idea, if you did and the gold price was above 1850, you would pick up the difference in the spread, which is about $10,000 minus what you paid to get in. So we're talking about $9,200 in profit potential on this spread. Again, that's if you hold expiration, and honestly, I probably wouldn't recommend you do that. You could do something similar in crude oil. Let's talk about crude oil. When I look at crude oil, I think it's a bit of a crossroads. There's a lot of uncertainty, there's a lot of volatility, and this creates an environment that could be favorable to option spreads. The last time crude traded in the high 70s, which is what we saw a couple of weeks ago, it waffled around for a couple months and then eventually collapsed to $40. You probably got knocked out before the drop if you were a bear, and the bulls may have been caught on the wrong side of a bad move. So this is a couple of ways you could play crude depending on if you're bullish or bearish, hopefully with a little less risk and a little more lasting power. My personal opinion, and I don't have a crystal ball just like anybody else's, I think crude's probably going to make its way to about $60, maybe even 57, which is where the last leg of this rally started from a few months ago. But of course, it could go the other way. If you agree with me and you think we have a chance to go lower, here's a way to play it without, again, spending a lot of money. This is called a ladder. So in this situation, we are selling 2 puts for every put that we purchase. In this example, we're buying a 65 put for December, we're selling a 60 put, and then we're selling a 55 put. The 2 puts that we sold almost completely pay for the put that we bought. So instead of spending $3,700 to $3,800 on that 65 put, we're only spending about $250 to $260. So you get into this trade really, really cheap. The margin on this trade is only about $1,500. So again, this isn't a recommendation. This is just to give you ideas on how you can play your ideas in the long run going into the end of the year without losing a lot of sleep, hopefully. Just like the other trade though, this position has unlimited risk because we're selling an extra option. The extra risk is below 55, but because we're making money from 65 to 60, our risk at expiration really doesn't come in until about $50. So as long as crude oil stays above $50 and you hold the expiration, you kind of break even at 50. If the market goes below 50 at expiration, it's like being long a futures contract. So your risk is theoretically unlimited below 50. I think we can all agree 50 isn't impossible, but it's quite a ways away. Hopefully, if it gets to that point, you can adjust or exit or do something before things get really ugly. In the meantime, if we get a move to the mid 50s, 55, 57 area, which is what I think could happen, this spread would work very well. You're only spending about $250 to get in, so, and it's a $5 spread. So if you held the expiration, again, I don't expect anyone to hold that expiration, but if you did, you'd make about $47.50. To give you an idea, if you get out before expiration, you're going to make a lot less than that because there's still time value built in the short options. But in a trade like this, if you're spending $250 to get in, if you could 1, 2, 3,000, I think we can all agree that's a home run. You can do the same thing with call options if you're bullish. And in fact, you could do both. If you're not sure where crude oil is going, I'm kind of that way. I'm leaning lower. I think it's going lower, but ultimately it actually could go higher. So you could play both sides. You could put the call spread right on top of it. Of course, it's going to cost you money for both sides of the trade, but crude's probably not going to stay where it is. It's probably going to pick a direction and run with it. So if you did the call spread, you'd be buying a 70 call, selling a 75 call, and then selling the 80 call. This is going to cost you a little more money because traders know that crude oil can go up pretty sharply when it does go up, and they account for that in the option pricing. So it's expensive, but for $860, you could put together a $5 spread. The most you can make on that if you hold the expiration is roughly $4,200, $4,100 before transaction costs. Again, don't expect to make that much because you're probably not going to hold the expiration. This is what it would look like on a chart. Your risk is above 80. You're making money from 70 to 75. Your risk is above 80. So could you get into trouble on this trade? Sure, but it's not likely. We haven't seen $80 in crude oil since fracking was invented. So anything's possible, but I highly doubt that's going to happen. But again, anything's possible. Actually, because you're making $5 on the spread, if it goes up, your risk is truly above 85, not 80. So it'd really have to get up there for you to get into trouble. Again, not impossible, but could happen. So hopefully you got some ideas on how to approach different commodity markets, especially when the volatility is high. Way to play things without having to worry about being stopped out. These types of option spreads give traders lasting power. So if you've ever traded futures and you've been stopped out, you know it's hectic to try to get back in. With this type of a trade, you don't have to worry about that. The markets can go against you, but you always have a foot in the door, unless, of course, your short option gets into trouble, and that's a different story. But when you do this sort of thing, make sure you're placing your risk way out of the money so that it's unlikely that those get you into trouble. If you want to learn more about option trading, my latest book, Trading Commodity Options with Creativity, has everything we just talked about today, plus a lot more in a whole lot more detail. TradingCommodityOptions.com will give you some sample chapters and some information. Here's my contact information again. If there's anything that we could do for you, let us know. Or if you have questions, let us know. Thanks a lot.